later on, but the focus for today is just on the income statement. So I have a question here. Can you see the question clearly?
Yeah.
Okay. So there is a company here, which is Fantastic Limited, that we're going to work on. It is just a 2-page question. Which textbook are you using at school for accounting?
We used to use the New Era.
Okay. Have you seen a textbook called a Top Class? You've not used it before, no?
No.
Okay, it's a very good textbook as well. New Era is good. Obviously, we will be using it, but we will be using also a top class textbook because it also explains some other things very well. So we're going to combine. So I have this question that I want us to look at now. Just for a practice on income statement. But also, I want you to pick up all the things that you feel that you're not comfortable with, because I want you to guide me on this question so that I get to understand you in terms of like what are the things exactly that you're not comfortable with on the income statement. So if you look at my spreadsheet here, I have a number line here. Can you see clearly everything that is on the spreadsheet? If you don't see something, you must let me know. I can zoom a little bit so that you can see. But if you are able to see, you can let me know as well. Is everything clear on the spreadsheet and also on the question, the writing?
Yeah.
Okay, good. I have a spreadsheet here. I will be doing workings with you on the spreadsheet. And also I have income statement format here that I've prepared for us to work on. We're gonna go with it up until the profit, net profit after tax, as you can see here. And then after that, I will go with you. This is the balance sheet part, but we will not be focusing on balance sheet today. We'll see it some other time. And I've also noted some few notes to the financial statements that I believe they're very important that we need to do. Of which these ones will be doing them more together with balance sheet. So it's a fixed asset note, and then we have note 5, which is trade and other receivables, and we have note 7, which is ordinary share capital. We have note 8 for retained income, and we have note 9 for trade and other payables. These are the notes that I want you to know. It's a must. The other ones, I'm not interested in those other ones, but we are going to work on them. But it's a must for you that you know trade and other receivables, you know trade and other payables, ordinary share capital, retained income, you know those, and the fixed asset notes. We need to be comfortable with those ones. So here is the question for the income statement. We have our required here. They're telling us what are the things that we need to do. I'm gonna go through what is required just now. But before I go there, I just want us to touch on a few things that you need to be aware of when you're doing income statement. Income statement is one of the financial statements that we have, that we are going to work on, right? We have different types of financial statements that you should be aware with different types of financial statements that you should be aware of. For the company to prepare the financial statement, it is required by the law, right? Because those are the statements that we present to who? We present the financial statements to the users of financial statements. Who are those users of financial statements? We're talking about the shareholders of the company, because they are the ones that invest their money into the company. So they will need to know how is operations going in the company, because do you know that shareholders are not involved in the daily operations of the company? Yeah?
Yeah.
Who is involved in the daily operations of the company?
Directors.
Exactly. Directors are the ones running the company. So they have to report to and they have to report to shareholders at the at least once a year at the annual general meeting, right? So they are going to report using what? Using the financial statements. Okay.
Yeah.
Now, Which are those financial statements we're talking about? I want us to mention few of them. Which are those financial statements that we're talking about? Please tell me the first one.
Income statement.
We have the income statement. Yes, we have the income statement. Next,
Balance sheet.
we have the balance sheet. Exactly. We have income statement. We have the balance sheet. Yes. Next,
The cash flow statement. The cash one. I can't remember.
cash flow statement. That's very good. Cash flow statement is one of the financial statements. Nah? And then next. We have what we call a statement of changes in equity. Have you heard about that now? Statement of changes in equity. That's one of the financial statements, right? I know, Guti, you're more familiar with income statement, balance sheet, and cash flow statement, but there is one called cash flow, statement of changes in equity, and also we have what? Notes to the financial statements, right? These are part of what? These are part of financial statements. We have what we call director's report. Director's report, that's part of financial statements. And then the last one is what? Independent external audit report, right? Independent external auditors report. So that's what we have as part of the financial statement. So for a set of financial statements to be complete, all these things that should be part of those financial statements that will be reported by directors to shareholders at the annual general meeting. Do you understand?
Yeah.
Yes, all these things, we are definitely going to work on all of these, all of them. But today, the main focus is on the income statement, right?
Yeah.
Yes, so these are just the financial statements that I wanted you to be aware of. Otherwise, here I'll be doing my workings here. It's I'm not going to be. I'm just gonna take these ones and put them this side. Okay, I'm just gonna put them this side. It's just, I'll send you the spreadsheet. For today, I'm just going to do my workings here. But I wanted you to know that we have income statement, we have balance sheet, we have statement of changes in equity, we have cash flow statement, notes to the financial statements, and we have what? Director's report and the auditor's report. All those things, they make a complete set of financial statements. And it is required by the Companies Act that the company prepare those financial statements. It's something that you need to be aware of before you do your balance sheet, before you do your income statement. Why are we doing it? Because it is required by the law that the directors of the company must prepare financial statements at the end of the year and present those financial statements to their shareholders as a report to show how our operations of the company during the year, and also they also need to present the balance sheet to maybe to indicate the financial position of the company as at year end. Okay. Yes, I just wanted to give you that information. Now, let's go straight to the okay. Again, before I go to the question, another thing I want us to talk about. I want us to talk about GAAP principles. Now, do you know GAAP principles?
Yeah.
Which GAAP principles you know?
Materiality, prudence.
Yes, materiality, prudence. Yes.
Matching concepts.
Matching concepts, right? Very good. Very good. Next.
Historical cost value, something like that.
Historical cost, very good. Historical cost, very good. Next, what else?
This, like, you have to keep your assets separate from your personal ones. Can't remember what it's called. Business entity or something like that.
Exactly, business entity. Business entity, yes. You keep your personal belongings separate from the company. What else do we have? The last one. There's 6 of them.
Mm,
Last one is going concern. Now, you still remember that one? Going concern. What does going concern? What is the meaning of going concern?
you operate like you assume that you're going to run the business for a longer period.
Exactly, beyond the current financial year. So you're going to the business will continue operating for the foreseeable future. That's what we're talking about. That which means like beyond the current financial year. Which means if it's the end of the year today, the last day of the financial year, I know that next year definitely I'm going to operate, and even next year the company is going to operate at least 12 months after year end. The company will be operating. So we're going to do everything as part of going concern. What does materiality mean? You remember what does materiality mean?
You group like some assets into one account.
We group some assets into one account. That's correct, but I want you to put it in a smoother way, né? Something when we talk about materiality, it's something that can affect the user's decisions, né? All those line items that are significant to the business, they need to be recorded separately in the income statement and the balance sheet. For example, if fixed assets, fixed assets, they are material, so they have to have their own line item in the balance sheet because they are material. Sales, when you talk about sales, if sales are material, they need to have their own line item. But if something is not material, we don't even have to show it as separately in the income statement or balance sheet because it's not material in terms of amount, right? Yes, we talk about materiality. There's something that can affect the user's decisions. Okay, that's what the materiality say, right? It can affect what it's that financial information that is important for us to make decisions. It has to be shown separately. Prudence. What can you say about prudence?
You don't overstate or understate your assets.
Very good, very good. Matching concept.
Each for every debit there must be a credit.
No, I don't agree with that.
Okay.
Matching principles, as it says, everything has to match, right? For me to generate an income, I need to spend some money, right? So which means now in the current financial year, I need to record income and expenses that I've incurred only in the current financial year. Anything that is outside should not be recorded in the current financial year. You get what I'm saying? Because our financial year is made up of 12 months. Né? So we talk about all the income and expenses that were incurred. Income will be earned in the current financial year. Expenses must have been incurred in the current financial year. Those two should be recorded in the current financial year. But everything else that was maybe incurred or income that we earned, but it's for the next financial year, it has to go to that financial year. It cannot come to the current financial year. You get what I'm saying?
Yeah.
Yes, that everything it has to match. The income has to match with the expenses for that financial year. I don't want to see you recording rent expense for next year, recording it in the current year. It affects the matching concept. it doesn't match with the current financial year because that expense is not for the current financial year, right?
Yeah.
So for income statement, this is the most important one, matching concept. This is the most important one that we are going to, because when you do those accrued expenses, income received in advance, do remember that we're taking them out. Prepaid expenses, we take them out because those ones, they don't belong to the current financial year. That's the reason why we're taking them out, is because we are trying to say they do not match with the current financial year. So this is the most important GAAP principle that we're going to apply in the income statement. Okay. Let's go through the scenario now. Let's go through the question and see what we need to do here. Okay. Please let me know when I'm reading. I also want to read with you. Are we discussing while we're reading, so that when you start answering, you are with me. I don't want you to be left behind. Yeah.
Yeah.
Yes. Example 1, Fantastic Limited. So they're saying here, Fantastic Limited is a public company with an authorized share capital of 500,000 ordinary shares. Okay, the financial year ends on 28 February 2014. So if it ends on 28 February 2014, when is it starting?
1st March 2013.
Okay, very good. 28 Feb 2014, right? Which means it is starting on the 1st of March, right?
Yeah.
So which means that is going to be 1 March 2013. It's very important that you do your number line when you're doing income statement, so that you can note everything that falls outside. So we only need everything that is within the 12 months period. That is a matching principle. Okay, let's carry on. The company had an issued share capital of 120,000 ordinary shares on 1 March 2013. Can you see that?
Yeah.
120,000 ordinary shares were issued on 1 March 2013, the beginning of the financial year. We already know, because said if it's ending 28 February, which means it is going to begin on 1 March 2013. During the financial year, the company sold an additional 50,000 shares at a market price of 4 rand each. Can you see that?
Yeah.
This has been properly recorded. So now here they're giving us more of ordinary share capital note information. Am I right? That is just an introduction. They're telling us like about the accounting period of the company. They're telling us about the authorized ordinary shares. They're telling us about ordinary shares issued at the beginning. They're telling us about ordinary shares issued during the year. So this is the information that is going to assist us whenever we do ordinary share capital note. I'll share this question with you so that you can also use it when you're practicing. Okay, required. Prepare the income statement for the year ended 28 February 2014. So that's what we're going to focus on today. Prepare the balance sheet as at 28 February 2014. We're not going to be doing balance sheet for now. Notes to the financial statements for the year ended 28 February 2014. Number 2 and 3, we will do it together when we do balance sheet. But for today, I want us to focus more on the income statement, which is number 1. Information, balance sheet account sections. Most of the balance sheet account sections, we know that we use them when we're doing the balance sheet, but some of the information here will also be useful while we're doing income statement. Are we together?
Yeah.
Perfect. Account, debit, and credit. Okay. The first one is ordinary share capital. They're giving us 700,000 here. They do not indicate that this is the one at the beginning or at the end, but we know very well that this should be at the end of the year, because this is the trial balance that they're giving us. So if it's not indicated that it's at the beginning of the year, it means it is going to be at the end of the balance at the end of the year. So retained income, they're telling us that this is retained income at the beginning of the year, which is 450,000. We're going to be using it on the balance sheet. Loan SA Bank, 126,000. This is the balance that we're going to be using it on the balance sheet. But when we're calculating interest expense and all of those things, we might have to use this balance. I don't know, but we will see when it's time to work on the interest expense. Land and buildings at cost, 965,870. This one will definitely have to go to, we're going to record this one. Where are we recording this one?
Land and buildings.
Yes.
In the balance sheet.
In the balance sheet, right? In the balance sheet. Yes, exactly. That one, we're doing it in there. In the balance sheet. Okay. Fixed deposit. Fixed deposit. Where is it going?
The balance sheet.
Balance sheet, yes. Equipment.
Fixed asset notes and the balance sheet.
Exactly. Accumulated depreciation also the same. It goes there. Fixed asset notes and the balance sheet. Motor vehicles. Accumulated depreciation. It also goes there. All this information, it goes to there. It goes to the. This information will go to the fixed asset notes. Trading stock. Where are we recording trading stock?
We use it for in the income statement for surplus or deficit.
Exactly, for surplus or deficit. So this one is going to help us to determine whether we have a trading stock surplus or have a trading stock deficit in the income statement. Very good on that. Debtors control.
We use it in the balance sheet.
We're definitely using it in the balance sheet. Can it assist us with anything in the income statement?
Bad debts, provision for bad debts.
Exactly. Provision for bad debts adjustment, right? Because when we go to the income statement, we call it provision for bad debt adjustment, right? So we are going to use it to check whether the adjustment is going to be an income or it is going to be an expense. Because we can have an income, we can have an expense. Am I right on that? Yes, so we are definitely going to use debtors control. Provision for bad debt at the beginning of the year. This is the one that we usually adjust to decide whether we have a provision for bad debt adjustment that is an income or an expense. Bank, balance sheet, cash flows goes to balance sheet. Creditors control, it goes to balance sheet. SARS income tax, it goes to a balance sheet. So what does it mean since this one is on a debit side? What does it indicate?
That SARS owes you.
Exactly. SARS is owing us. No? SARS is owing us. This is a receivable. It is a debtor because SARS is owing us. Thank you on that. Now let's go to the nominal account section. These are the line items that we definitely going to use in the income statement. Okay. Sales. How much? Where is our sales going? We're going to our income statement, right?
Yeah.
Yes, so I'll just come here straight. I'll say sales. How much is the amount that we have here? 2,010,000 rands. So I'll just put 2,010,000 and 10,000 rands here as part of my workings. So that is for sales. Cost of sales 968,000. I'll take it to my cost of sales as part of my workings. Obviously, we'll start by doing this thing. Am I right on this? 968,000. Why are we doing this, putting it on brackets? Is because we don't know whether there will be any additional information that will affect sales or cost of sales. So we can't just take it to the total while we're starting. Debtors allowances. How do we deal with debtors allowances?
We subtract it from sales.
Why are we doing that?
Because they return the item, so it's no longer a sale.
Exactly. Very good. Very good. Yes, you can carry on. You can carry on. You're saying something?
I said it's no longer an income for the business.
It's no longer an income for a business. Yes, when a debtor returns something, we have to maybe credit their account and also debit the sales, which means now we're reducing the sales. The sales that we've made of 2,010,000 have to subtract the 14,000 rands. That's why we're going to say 2,010,000 minus 14,000, because a debtor might have returned something which is no longer a sale. Okay. Salaries and wages, 185,000. That is an expense, no? So I'll go to salaries and wages and say 185,000 rands as part of what? As part of our expense. 185,800. Sorry, 185,800. Okay. Next we have rent expense, 35,200. That is an expense. Rent expense, 35,200. Where do we have rent expense here? Oh, we have it here. How much do we have as rent expense? That is 35,200, right? 35,200. Okay, I'll put it on bracket. Insurance, 10,520. It is also an expense. Insurance. We have the 10,520. Next, what do we have? This is a very basic example. Water and electricity, we have 6,300, which is water and electricity, 6,300 rand. Telephone, 10,800, which is also an expense, 10,800. That is what? That is the telephone expense. Packing materials were 14,000. How do we deal with the packing material?
Usually if there's like extra, then you'll put it under consumable stores and you'll subtract it from the current year's amount.
Exactly. So from this, probably this is the packing material that we purchased during the year, right? And now we will need to know how much was left at the end of the year. And then the difference would be the one that was utilized, which is going to be an expense. So I'll keep this packing material, which is 14,000. I'll keep it here because now I need to know how much was utilized on this one. And then the difference will be, the difference between this one and the one that is left at year end will be the packing materials that was used during the year, which have to be expensed because of that. Okay. Director's fees, 450,000. What is director's fees?
An expense.
That is an expense, yes. That is a salary or that a payment that is made to our directors. No? Audit fees were 50,000 rands, which is, this is audit fees, I'll say 50,000 rands. Bad debts, do we have anything about bad debts here? 7,700. That is bad debt, 7,700. Okay. What else do we have? We've considered all our debits. Okay, we still carrying on here. We're not done, but we have discount received. Discount received is an income, ne?
Yeah.
4,120. Discount received, I'm going to have what? 4,120, which is an income. Bad debts recovered, 4,300. That is an income also, ne? 4,300. That is a bad debts recovered. And then what else? Interest on fixed deposit. Where do we record the interest on fixed deposit?
Balance sheet.
Interest, not really a balance sheet. Fixed deposit is a balance sheet, but the interest.
Income statement by the...
Exactly. Sorry, please come again.
By the operating income.
Yes, by operating profit, So we're going to have what? We're going to have interest income here. That's what we're talking about. It is going to be these 2,500. And we're going to check if there's any other additional information that we might have to consider. Okay. Trading stock deficit, 1,000. Expense or income?
Expense.
Yes, expense, 1,000. This is a trading stock deficit. And then we have sundry expenses, 17,780. It has to come here. Sundry expenses, 17,780. You see, your starting point is to plot all the amounts that you have on your trial balance. Commission income, 17,000. That is going to be an income. So it has to go up there to other operating income. And how much is that? That is going to be 17,000 only. Okay, 17,000 rands. Okay, anything else? Dividends on ordinary shares, where do they go?
Balance sheet.
Yes, dividends on ordinary shares. These are the interim dividends that were paid during the year. So they're not going to be part of what? They're not going to be part of the income statement. Dividends don't go to income statement, but they go straight to the retained income note and they will be transferred to the balance sheet after that. Okay, so we have plotted everything. We have now plotted everything that is on the trial balance nominal account section. Now we need to deal with the adjustments and additional information so that we can see what is happening. What are the things that we need to adjust there? What are the things that we don't have to adjust? Okay. So here they're saying on 27 February 2014. When is that day?
Month end. Almost month end.
Exactly 1 day before, right? Because our year is ending 28. So which means there is a day before year end. Goods were sold for cash to a customer. The marked price of the goods was 2,400. No entries have been made as yet. Goods were sold at a markup of 60% on cost. How do we deal with this transaction?
We work out the cost value and then you put the 2,400 into sales and then you put the cost value into cost of sales.
Exactly, that's additional sales, né?
Yeah.
Yes, very good. So let's go to our workings now. Let's go to our workings and see how we're going to do this. So what must I do in terms of my workings? 2,400 times?
2,400.
Yes.
Times 100 divided by 160.
Times 100 over 160. Very good. Times 100 over 160. Okay. So how much am I getting there?
1.5.
1,500, yeah?
Yeah.
So what is that 1,500?
Your cost of sales.
This is my cost of sales, right? This is my cost of sales. So which means now I need to go to my sales and add. How much must I add on my sales? I need to say plus 2,400. Am I right?
Yeah.
I need to say plus 2,400. And then under my cost of sales,
Plus
1,500 rands, right? Plus 1,500 rands. Anything else that we need to do with this transaction?
No.
Nothing else. Very good. I'm happy how you treated the transaction. I'm happy how you dealt with the transaction. Okay. Number 2, stock taking on 28 February 2014 reflected the following on hand. Trading stock, 133,700. What do we do with this one? Packing material, 3,500.
For the trading stock, you look at the amounts that you had in the trial balance.
Yes, let's go and check. We have 136,000. Okay, TB, I'll just say here, I'll go there and say trial balance. TB, we have 136.
Yeah.
That is the amount that is on the trial balance. How much is it? For trading stock, 136. And then how much was there? There they said 133,700. Okay, then additional information. And they're saying it's how much here? It's 133,700. Okay, what are you saying?
You work out the difference, and the difference will give you the trading stock deficit.
Okay, perfect. That's good. We're going to have a deficit here because this is the physical stock count is giving us 133,700, but according to our books we have 136, so which means there will be a loss of how much?
2,500.
136,000 minus 133.
I put the wrong amounts.
Yes, how much you getting?
2,300.
2,300. Okay, 2,300. Which is very good. This is supposed to be a trading stock deficit, yeah? Yes, but let's consider these goods that were sold. Remember here, there were goods that were sold here. Still remember that?
Yeah.
There were goods that were sold there, but we need to take them out first on the trading stock because they said no entries have been made as yet, which means we sold something for 2,400 and we said how much was the cost? We said the cost was 1,500, yeah?
Yeah.
Yes, so which means now this inventory that is on the trial balance, we need to subtract 1.5 here because it was not recorded. So we have trading stock here of 136,000. We need to say minus 1.5. So if we say 136,000 minus 1,500, how much are we getting?
How
much are we getting?
For the whole, I got 800 after also subtracting the 133.
Okay, after subtracting 133, you're getting 800. So which means now our deficit becomes 800. Am I right?
Yeah.
You agree with me on this one?
Yeah.
Yes, definitely, because we have to take out the goods that were sold. So which means our workings will be 136,000 minus 1,500. Yeah? So that will be, we're gonna take this minus and then we say minus 133,700 minus 133. Okay, let me just say first is equal to, if we say 136,000 minus 1,500, that is going to be 134,500. Am I right? Then now we're subtracting 133,700. And then how much are we going to get? We're going to get the 800. So which means now this is going to be my workings to get to that deficit of 800. So which means now I need to go to my trading stock and say, where's my trading stock deficit? Do I have a trading stock deficit here?
Yeah.
Trading stock deficit, it was 1,000. So we need to add how much here?
800.
That's 800, yes. maybe we can close it now and have 1,800 here, né? Unless if there's something else that we need to, unless if there's something else that we need to add, unless if there's something else that we need to add. Are you happy with this one?
Yeah.
Okay, thank you on that. I'm happy that you are happy. Packing materials. So what did we say about these packing materials of 3,500?
You're gonna look at the trading balance amount.
Yes, on the amount on the trial balance, ne?
Yeah.
So let's go and see what did we have for packing material there? We have 14,000. Can you see that?
Yeah.
14,000, and here we have 3.5.
It means that you only use 3.5.
It means we only used 3.5.
Yeah.
Why are you saying that?
It means that 3.5 is the amount that's not used because you still have it after the year end.
Yes. So how much we used?
We used. Can you go back up, please?
Yes. It was 14. It was how much? 14,000 packing material.
So.
And then 3.5 down there. 3.5.
1,500 for the year, and then you have 3.5 left over.
Yes, 3.5 will be part of inventory, the closing inventory, yeah? And trading stock, but 10,500 will be the one that will go to the income statement. Am I right on that? So I'll say here minus 3,500, which is going to give me how much? 10,500. 10,500. Okay. Thank you on that. Are you happy with this one? Yeah?
Yeah.
Perfect. Let's go to number 3. What is number 3 saying? Write off a further amount of 1,200 as bad debt, and thereafter adjust the provision for bad debt to 3% of the trade debtors.
You're gonna add.
Yes.
You're gonna add it to bad debts, the 1.2.
The 1.2, that's an additional bad debts that are written off now. So which means now I'll say plus 1.2 here. Okay.
And you're gonna go to the debtors control in the trial balance.
Debtors control in the trial balance, yes.
Times it by
42,000, yeah?
Yeah.
Then we times it by
3%.
We times it by the 3%, okay. And then how much are we getting?
1,260, and then we add that to bad debts.
Okay, can I just do the workings quickly here? You're saying I must take 42,000. That is debtors control, and then I times it by 3%. Yeah? That's what you're saying, yeah?
Yeah.
And then how much are we getting there?
1,260.
1,260, yes.
And then we add it to bad debts.
We add the 1,262 bad debts. You mean like which bad debts? These ones, no? These ones.
Yeah.
Down as a part of an expense.
Yeah.
Why are we doing that?
Because we didn't receive 3% of the debtors amount.
Not really. Now you see what happens now, yeah? what we're doing now, let's look at the transaction again. And then they said and thereafter adjust the provision for bad debts. Now we're talking about provision for bad debt adjustment. We're done with bad debts now. We're done with bad debts. There's nothing else that affects bad debt. It was only this 1,200, and we've already adjusted it because we went to our bad debts there and said plus 1,200. Can you see there?
Yeah.
We said plus 1,200, which means now we have adjusted our bad debt. But the remaining part of the transaction, they said, and thereafter adjust the provision for bad debts to 3% of the trade debtors. We need to go up to our trial balance first and see how much is our provision for bad debts that we have here. Can you see how much we had at the beginning of the year?
Yeah.
At the beginning of the year, we had how much? 2,000 provision for bad debt at the beginning of the year. But now the transaction is saying we must adjust it to 3%. Are you with me?
Yeah.
So which means now that amount that we had at the beginning of the year, we have to adjust it to 3% of the trade debtors, which means I need to calculate 3% of the trade debtors and then compare with that opening balance and see if I'm going to have a provision for bad debts adjustment. There is an income or an expense.
Oh, yeah.
So which means the bad debt as an expense, they are no longer affected by this transaction now. It was only the 1,200 that affected bad debts. Are you with me?
Yeah.
Okay, so let's go and let's do that now. But remember, when we're dealing with trade debtors, the starting point will be here. Because when you're doing workings for this, you start with your debtors control, which is 42,000, right? So I will come here and say on my workings, I'll start by saying 42,000, which is the one from the trial balance. That is debtors control. Are you with me on that?
Yeah.
So if I say if I say 42,000, what I need to do first, that is the 42,000 on the debtors control. What I need to do first, I need to subtract this 1,200 bad debt from that debtors control first before I multiply it by 3%. Are you with me? Yes, before I multiply it by 3%, I need to say 42,000 minus how much? The additional bad debts, which was 1,200. I need to subtract it. So I need to say minus 1,200. After subtracting it with 1,200, now I need to say multiply by the 3%, which is going to be 3 over 100. How much are you going to get there? How much are you going to get?
1,224.
1,224, right? So from this 1,224, now I go and compare it with that opening balance. Now I need to go and compare with the opening balance so that I can see that I adjust it upward or downward, so that I know whether I have an income or I have an expense, right? So let's go and see how much do we have. Provision for bad debts adjustment, we have 2,000 at the beginning of the year. We're 2,000. So now we're adjusting it down to 1,224. So which means, is that going to be an income or an expense?
Income.
It is going to be an income, definitely, because I'm taking it from 2,000 down to how much? To 1,224. So my workings will carry on and say 2,000 minus 1,224. And then how much am I going to get here?
776.
Exactly, 776. That is going to be my provision for bad debt adjustment. Can you see how we calculate it now?
Yeah.
Yes, this is the provision for bad debt adjustment. So the starting point is what? You take your debtors control, né? On the trial balance. That's your starting point. Number two, what you do, you go and check on your additional information. you go and check whether there is any additional bad debts that were written off, and you find out that yes, there was 1,200, right? You subtract this 1,200 from, you subtract it from that debtors control. Am I right?
Yeah.
Only the one that is on the transactions, additional transactions, only that write off that bad debt. So we take the balance on the debtors control balance on the trial balance, subtract the 1,200, which is a further amount of bad debts that were written off. After that, you multiply it by 3%. Right? Once you have done that, compare with the opening balance of provision for bad debts on 1 March at the beginning of the year, which is 2,000, and we find out that we're adjusting it from 2,000 to 1,224, and then we're getting 776, and we are saying this is going to be a provision for bad debt adjustment, which is going to be an income, right?
Yeah.
Yes, which is going to be an income. Does it make sense?
Yeah.
Okay. So now I'm going to say here provision for bad debt adjustment. Now we call it provision for bad debt adjustment. And then I'm going to have how much here? 77,776. I can just do short workings here and say 2,000 minus 1,224, right? And then this is what I have. But these workings will also help you in terms of checking how we got to the amounts now. Are you happy? Are you following?
Can you go back to the transaction?
Yes.
I just want to see the wording.
Or the wording, yes. That's very important as well. Let me remove the highlighters now, so that you can see.
Also, every time it says like furthermore, it hasn't been counted.
Yes, write off further amount of 1.2, because the only one that was counted is this one, is the one that is already on the trial balance. You see, we have bad debt here of how much? 7,700. This one has already been counted in this debtors control. As you can see, a debtors control of 42,000. That one has already been subtracted, right?
Oh.
But the further one, write off a further amount, that one was not subtracted. So that's why what I need to do, I need to subtract that further 1,200 from debtors control. I subtract the 1,200, and then what do I do after that?
You times it by 3%.
Exactly. You multiply it by 3%. And then from there, yes. Come, carry on.
You compare it to the opening balance of the provision for bad debts.
Exactly. And then you check whether you have an income or you have an expense, right? If it goes up, it's an expense, né? But if it goes down, it's an income, right?
Yeah.
Are you happy with the transaction?
Yeah.
If you see now, you need 10 more, as I said yesterday, né? You need more of these transactions. Do them one and again, repeat them. You'll master them after that. You will master them. But we are still going to do another question, and we are going to deal with this type of transaction, and we will be okay. And another thing I want you to be careful of. You see these goods here, when they said goods were sold for cash to a customer. These goods, if they were sold on credit, for example, if they were sold on credit and no entries have been made, if they were sold on credit, this 2.4, which means that debtors control would have been understated, this one. You get what I'm trying to say?
Yeah.
So which means now my starting point will be taking this 42,000 plus plus this 2.4 first, because this would have been sold on credit. I'm just making an example, né?
Yeah.
So it was going to be that debtors control plus 2.4 minus 1.2. Then I multiply it by 3%. You see things that we need to consider, né? This one, I didn't consider this 2.4. We don't have to consider it because this is a cash sale. It was sold for cash. So it has nothing to do with debtors control. This one, it goes straight to the bank. So that's why it doesn't affect this debtors control. But if it was sold on credits, because some other transaction, you will find out that they will come to you and say, on 27 February 24, goods were sold on credit to a customer. So which means now that's a debtors control. That amount should be added to that debtors control there. That's why a starting point, you take that debtors control, you add 2.4, this one, and then you subtract the 1,200. After that, you say times 3%. Yeah?
Yeah.
Okay, are you happy with this one? We can move on now, no? Okay. Let's go to the next one, which one is the next one? And the next one is going to be number 4. Insurance is paid 1 month in advance. The insurance premium was increased by 5% on 1 January 2014. Okay, let's talk about this one. They're telling us that insurance is paid 1 month in advance, right?
Yeah.
So the insurance premium was increased by 5% on 1 January 2014. So if they say insurance is paid 1 month in advance, so how many months we paid for?
13.
There's 13, right?
Yeah.
And then there's 13, exactly. There's 13. And then if they're saying 13, and then they're telling us that the insurance premium was increased by 5% on 1 January 2014. So which means now how many months had an increase?
3 months.
Which are those months?
January, February, and March.
Exactly, January, February, and March. You see, this transaction is a similar type of a rent transaction that they usually give us, no?
Yeah.
Yes, so we need to deal with it then. So what is my starting point in terms of dealing with a transaction like this? Because you noted it yesterday to say a transaction like this gives you a problem where you want us to work on it, no?
Yeah. You take the insurance amount.
Okay, let's go and check it first. Insurance amount, I'll go to my trial balance and say insurance amount, where is it? There is it there, 10,520. Can you see that one? 10,520. So that's the insurance amount. We have 10,520. Okay.
And then you paid for, and then you put an equal sign, and then you put X in front of, and then you put it.
Yes.
And you 10 times 100%.
I put an X and say times 100.
You open and you say 10 times 100%.
10 times 100. 100% like this, no?
No, not like that. Just 100.
Okay, I say hundreds, no?
Yeah.
Okay.
10 times 100.
I say 10 times 100.
Yeah.
You mean like I need to do it like this, 10 times 100.
And then you close the bracket.
Yes.
And then you say X.
X.
And then you say 3. open the brackets, and then you say 3
3, yes,
times 103.
3 times 110, 103, 103. Why are we saying 103?
Because you paid 3% more than you usually
2%
would.
more, right? Did they not say 5%? They said 5%.
Oh, 5%. 5% more. So instead of 103, you'll say 105.
Okay, sorry, I lost you. I lost you. So what must I say? 105, ne?
Yeah.
Okay. And then what else must I do after this one?
Then you will get.
Now trying to solve for x, ne?
Yeah.
Am I not supposed to say plus here?
Oh yeah, plus.
Then now I need to solve for x, right?
Yeah.
So which means how am I going to do that now? What must I do? What is my next step?
You solve what's in the brackets, and then you add the amount that's in the brackets together to get x, to get 1315x, and then you divide it from 10,520.
Okay, so which means now I'm going to have 10,520. Let me just say 10,520 is equal to 1,315x, right?
Yeah.
Like this. This is what I'm going to have now, yeah?
Yeah.
Okay, then I say 10,520 divided by 10,520 divided by
1,000.
1,315. Then I get what? 8 is my x, right?
Yeah.
X is equal to 8. Okay, next.
And then you put it back into you say 8 times 3x plus 8 times
Next.
3.
Okay,
You
let's
say
start with the first one. Yeah?
yeah.
1,000. Okay, you can lead me. Let me not confuse you. Yeah? Can carry on.
Then you put 8 into. You say 8, open the brackets, and then you say 3 times 8 plus 105, and then you get an amount, and then you divide it by 3, and then that will be the amount you're supposed to subtract for March.
Okay. I'm sorry to cut you. Ne? What is the purpose now? We're trying to find an amount before increase and also an amount after increase. Ne?
Mm.
We're trying to find an amount before increase, and we're also trying to find an amount after increase. Am I right on that?
Yeah.
Okay, you can guide me then. Which one we're going to work on first? Before increase or after increase?
Before.
Before increase, now, because we do have a total. Now, right? Because we do have a total which is 10,520, right? And we know that before increase it's 100, right? Before increase it is 100. So which means now, if I can say 10,520 times, if I can say 10,520 times 100, because before increase is 100%, right? is
Yeah.
100 over, what is the total? 1,315. Am I right? 1,315 in total. That is going to give me before increase. But if how much am I getting then here?
Mm.
We're not getting 800.
Yeah.
Okay, let's check after increase and see if we can get it. So 10,520 times after increase is going to be 105, right? Am I right on that?
Yeah.
Okay, divided by 1,315.
Yeah. And then you get 840.
Then I'm getting how much? 840. So which means now we can test it then if it's gonna work. We said in total. We said in total how many months are there? We said there will be 13 months, right? But only 3 months is 3 months is after increase, and then the other ones is before. So if we say 800 times 10, and then 840 times 3 to see if we're getting the 10,520. So let's double check it. If we say 800 times 10, how much are we getting? And then we're going to say 840 times 3. Am I right on this one? So 800 times 10, how much are we getting there?
8,000.
We're getting 8,000 there.
Yeah.
We're getting the 8,000 rands. Okay. And then 840 times 3?
You get 2,520.
2,520. Okay. So how much is the total of these two? We're getting the 10,520, right? So which means we're correct in how we're doing it now.
Yeah.
Okay, very good on that. So we're correct. Then now let's go back to the transaction then. But because the aim here was to differentiate between 800 and 840, we needed to know a monthly fee before increase, a monthly fee after increase. You understand, you follow the methodology, the logic on how we got the amounts now. Okay, so let's carry on. Let's see now how much what was the transaction saying? Insurance is paid 1 month in advance. The insurance premium was increased by 5% in 1 January 2014. We just want to take out that extra month that includes an increase. So the only 1 month that we want to take out is 840. Am I right?
Yeah.
So which means now I need to go to my insurance and say 10,520, as you can see here, minus 810, 840. Why am I separating this 840?
Because it was paid in advance and it's not part of the financial year.
Matching principle, very good. It's not part of the current financial year. It is outside the current financial year. So it does not comply with the matching principle, right? It doesn't comply with the matching principle. So we know that we have 840 now that has to be taken outside. And we are sorted with that. We are okay with that. So are you happy with the workings?
Yeah. I see where I was going wrong with the...
You mean with the axis, né?
Yeah.
Yeah, no, it's fun, but you were trying, like you see the starting point here. The starting point here, you were going right. Somehow after that, it was lost. But you see what is more important here is to say I have 100%, right? 100, I have 100% multiplied by 10, right? And then which is going to give me how much? If you say 100 multiplied by 10, because you said the 10 months were 100%. Am I right on that?
Yeah.
Which gives me how much? 1,000%. Okay. And then I'm going to have now 105. 105 multiplied by 3, né? Which gives me how much? 105 multiplied by 3, how much am I getting?
315.
I'm getting 310, 315. Okay, so the total, that's how we got that. That's how we got that 1,315. That's how we got that 1,315 in total. So now after this total, I know very well that what I need a month after increase. So which means now I need one of these. I need one of these, right? And this 315 is because of 105, 105, 105. So I need only one 105. So I'll take 105. I would say 10,000. Okay, I'll just say 10,000, which is that total. It was 10,529, 529. And then I say multiply by 105 over the total, which is now going to be 1,315, 1,315. That's when I'm going to get that 840. So our calculation was supposed to be like that, of which it's the same approach as this one, but your methodology, you were coming right. I'm happy how you tried it, which is a very good thing. You can see how we're going to tackle the ranked one.
Yeah.
Yeah, we just check the percentage before increase. We multiply it. If it's 10 months, we say 100 times 10, we put it aside. And then the percentage after increase, 105 times 3, we put it aside, we get a total. And then we just take 1 month over the total. We get the amount after increase. So here we were able to get them both before increase and after increase. Then we're sorted. Okay, so that was it. Ne? That was it. Are you happy with the calculation?
Yeah.
I'm happy to hear that. I'm happy to hear that. Okay, let's carry on. I know Guti time is gone now, but we're gonna try and do a few more transactions and then we can finish the work tomorrow now. Yes. Rent for February has not yet been paid. Well, how are we going to deal with this transaction? Number 5.
We're going to since rent for February has not been paid, we have to add on an extra amount.
So how many months have been paid?
11 months.
Only 11 months. We're 1 month short, ne?
Yeah.
How are we going to know how much is that 1 month?
We'll divide it by 11.
Exactly. 35,200 divided by 11. How much are we getting?
Um, 3,200.
Exactly, 3,200 rand, which means I need to go to my rent expense and say plus 3,200 rand. This one is simple and straightforward, yeah? Yes, I need to go to my income savings under rent expense, and I need to say plus 3,200 rand. Okay, can we go to the next transaction?
Yeah.
Then they're saying provide for the outstanding interest on fixed deposit at 9% per annum. Interest on fixed deposit, they're saying at 9% per annum. So what is going to happen now there?
I'm going to check the trial balance.
You're going to go to the trial balance, yes? Yes, on the trial balance, what happens there? We need to check our fixed deposits, ne?
Yeah.
How much is our fixed deposit?
40,000.
Fixed deposits were 40,000 rands there, yes. So which means now what are we going to do with that 40,000?
We're going to times it by 9%.
40,000 times how many percent? Let's go and see. Provide for outstanding interest on fixed deposit, 9%. So how much is the interest in total supposed to be?
3,600.
It is supposed to be 3,600. Did we have anything on the interest income? You see here how much we have. We have 2.5 here. How much is outstanding then? Because in total, I'm supposed to have 3,600. So how much is outstanding that I need to add here? You remember, you saw what the transaction said. They said provide for the outstanding interest, which means there is an interest that we received of 2.5, but there was an outstanding amount. How much would that be?
1,000.
1,100. Yes, very good. 1,100 now?
Yeah.
Yes, very good on that. So that is our interest. In total, it has to be 3,600. Okay. Then now, commission income. Commission income includes 1,900 received for March 2014. What happens with this one?
You're gonna subtract it from commission.
The commission. Why are we subtracting it?
Matching principle.
Exactly. Matching principle and matching concept is still okay. Even if you're saying matching concept, matching principle, well, that's the reason why we're subtracting. It falls outside the accounting period. Yeah? How much is it? 1,900 rand. So on my commission income, I need to say minus 1,900 rand. Yeah? Okay. Then we have the loan statement received from SA Bank on 28 February 2014 reflected the following. Balance on 1 March 2013 at the beginning of the year, 150,000. Monthly repayments per month, including interest, 24,000. And then balance on 28 February 2014, that is 142,000. Okay. Then make a provision for interest on loan. So how much will be our interest now? How are we going to calculate this one?
150,000 minus 140,000.
Minus 140,000.
Yeah, and then you realize you get an 8,000 for interest.
Okay, please come again. What are 150 minus 140? Where are we getting 140?
It's from the bottom.
It's from the bottom, ne?
Where the transaction was.
Okay.
Oh, that's I subtracted the balance from the other balance.
Yes, how we going to work out this one?
Can you go back up?
Yes, you can go up. See what we do, what we have there. We have a loan of SA Bank, right? Of
Yeah.
which we have 126,000 there. Can you see that?
Yeah.
Okay. We have the 126,000 rands that we have there. But this side, we have a balance of how much? 142,000.
Yeah.
How much we have there on top?
126,000.
126,000, right? But how much we have here? We have 142 as what? As the closing, ne?
Yeah.
As what? As the closing balance. So which means now, if we take the difference between the two, this balance, with which it was calculated, including the interest on the loan, which they didn't tell us. They didn't tell us how much was the interest percentage of the loan, and then we subtract the loan that is sitting on on the trial balance, we are going to get the interest expense 126,000 minus the 142,000, which includes the interest. How much then the interest that we're going to get?
16.
Then we have the difference, because look, if you look here, they said monthly repayments per month, including interest, right? Monthly repayments per month, including interest, which means now these were the payments that were made, but they also include what? They also include interest, which means we don't know how much of this has interest, how much of this 24,000 has interest. But if we need to put interest on the credit side, and the remaining amount has to go on a debit side, which means the interest was incurred and was also paid at the same time. And then the balance that we have here, which is 142,000, already interest have been catered for. Then we just need to subtract the difference between the two, the 126,000, and then we're getting our interest of how much? The interest expense that we calculate. You said how much we have there as an interest expense?
I got 16,000.
Wow, what we subtracted there for us to get the 16,000, we took the one on the trial balance, which was 126,000 minus 142, ne? 142,000 minus 126,000 rand. And then how much are we getting? We're getting the 16,000 is what? Is there? The 16,000 is what? As the interest expense.
So I still don't understand. Can you please repeat?
Okay, let's go back to it again. Eh? Let's go back to it again. You see here we have a loan SA Bank, which is 126,000 rands, right? This is a pre-adjustment. This is a pre-adjustment trial balance, which means now before the interest was catered for. That's the one that we have on that is the loan with SA Bank. We owe it reflects that we're owing 126,000. Okay. Which that one didn't include the interest. Sorry, it didn't include what? It didn't include the interest. But if we look here, they're saying the loan statement received from SA Bank on 28 February 2014 reflected the following. Balance on 1 March 2013 is 150,000. That's the amount that we owed, right? That's the amount that we owed, 150,000. Okay, that's the amount that we owed. And then if you look here, they're saying monthly repayments per month, including interest, which is 24,000. So initially the opening balance was 150,000, and then we have monthly repayments of 24,000 rands. And then these monthly repayments, they including what? They including interest. They including what? Interest of how much? Or the interest is included there, but we're not really sure how much is the interest and how much is the interest and how much is the monthly installment that we have there. That's what we're not really sure. So it means now what we need to find out there, we need to find out how much is the interest in total that we're going to get. Interest was paid, so it means now we can also get we can also work on it using what? Using a T account. By including the interest there, it means this opening balance, it was calculated, interest already been considered, right? The interest has already been, because they're saying can make a provision for interest on loan, which means now from this balance that we have at the end, we know that interest have been considered. But the interest that we have, the balance of the loan that we have there, no interest was considered there. If we can see, this one is less than the balance that we have there, right? Which is 142,000 this side. So because of that, we having an assumption that the interest is included on this one, but also they told us here, obviously, to say including interest, which means from this balance, interest has already been considered, which is 142,000 on this 126. No interest was, we never told, there's even no bracket here to say 10% interest or whatsoever. And because of that, so we take the difference between the two, 126,000 that didn't consider the interest, and then we take 142,000 that considered an interest. Then we're getting how much? Then we're getting the difference between the two. That will be our interest expense that was not considered there.
Oh, I understand now.
Yes, it is a matter of that. Otherwise, they wanted us to trick us to say we only use these values. It was not gonna, we're not going to get the right amount because we cannot split here. These are monthly repayments per month, including what? Including interest. But we don't know how much interest is in there. But we know very well that this closing balance, interest has been considered. You see this 142,000, interest has been considered, but the other one, no interest was considered. So if we take the difference between the two, that's when we're getting how much? That's when we're getting the 16,000. Right?
Okay. Yeah.
Yes. And then what else we're going to, so which means now we're going to have our 16,000 as what? As our interest that is going to reflect on the income statement. Okay. Let's carry on. So it's just 142,000 minus 126,000 rands, and then we're getting the 16,000 rands, which is going to be recorded in our income statement. So it's a balance before interest, it's a balance after interest. The difference is 16,000, which is going to be an interest expense. You will see when we deal with other transactions that involves the loan, others they split the two, so we can do a workings based on the amounts that we have here. It will make things easy for us. But when we do other transactions, we'll come back also and compare with this one and see how we work on it. Yeah? Okay. Okay. Let's carry on with the other one, which is going to be how much? Provide for depreciation as follows. So now we need to calculate depreciation. I want us to stop here, né? Because I don't want us to do a lot. I want us to stop here, and then when we carry on tomorrow, we're going to carry on from 9, 10, 11. We do these calculations, and then we finalize, right? Then we finalize. How are you feeling about the today's one, Canela?
If I feel better because I see what I was doing wrong, and I finally understand.
I'm happy to hear that. Yes, it's still early. It's still very early, né? Right now.